Airbnb just released their Q4 earnings. We have to go through the numbers here today, look at the actual earnings summary, look at the key financial data, but also the key business metrics. And in the end, we're going to go through the valuation of Airbnb. Where is it at after these earnings are announced, and how did the market react overall? Hey, if you're new here, this is Robert and welcome to my channel. Leave me a like here if you like the content and consider subscribing as well. But let's get straight into the earnings. So we do see Airbnb after hours here up 5%, already up 6% for the day. So that's over 11 to 12% up for anticipation of the earnings, plus the first reaction of the market after hours. We do have some key headlines here. Revenue was reported for the quarter at $1.53 billion versus $1.46 expected, so over $70 million beat. Adjusted earnings per share was coming in at 8-cent positive versus 7-cent positive, so a slight beat here from that perspective. And gross bookings value was 11.3 billion versus 11.9 billion, so also a slight beat there. Up on that announcement, the shares rose as much as 6% after hours. But let's dig deeper into the numbers to see how the metrics compare quarter on quarter, year on year, but also how do the financials look like. So I'm here in the earnings release, the shareholder letter for the Q4 of 2021 of Airbnb. We do have some key metrics here for the business, such as that 73.4 million nights and experiences were booked on the platform for that particular quarter, which is up 59% year on year, slightly down from 2 years ago. So you will see throughout the report, they're actually comparing not only to last year, but also to 2019, as 2019 was seen as a, COVID-free, clean comparison, because 2020, obviously, we had a lot of interruption due to lockdowns and further travel restrictions. So they do the comparison here. So nights are up from last year significantly, still a little bit behind from where they used to be 2 years ago. However, gross bookings value is up from last year, 91%, so almost double up, plus 32% up from 2 years ago, which means that, although the nights and experience booked were less, we were able to, or Airbnb was able to actually make more money in terms of the average daily rate. So the daily rate that they charge, or that the hosts charge their guests on a per night basis. For the year, we do have a similar picture here. So we are up, we have 300 million nights booked, up 56% year on year, still down 8% from 2019 as a comparison. However, gross bookings value has the same sort of story here. So we are up 96% for the total year of 2021 compared to 2020. And we're also up 23% when you compare 21 to 2019. So we do have a trend here that, average daily rates, the bookings per night were more expensive in the last year, so that we were able to generate more income, more gross booking value with less nights and experience booked. And then one interesting thing that I noticed here is that actually gross nights booked, if you exclude the cancellations, we do exceed the numbers of bookings for Q4 2020 and 2019. So we do have we exceeding it by 4% from 2 years ago. So that just shows that we do have more interest, we do have more bookings, but due to COVID and due to sometimes circumstances changes and so on, so people are tending more to cancel these days, which negatively affected the overall nights booked that were actually, where actually people showed up and actually paid for. But we had gross bookings actually, or gross nights booked actually exceeding both years. In terms of a geographic mix of revenue, we did have growth pretty much all over the world. So we had in North America, nights and experience booked increased by 20%. EMEA, so the European, Middle Eastern and Africa area, was actually down slightly below 2019 levels due to primarily emergence and uncertainty around Omicron. So that was obviously a factor here. However, in other areas of the world, such as Latin America and Asia Pacific, we also had a 22% respectively growth over that period of time. Asia Pacific up 8% for the quarter, so also some decent growth there. Something really important to call out, which kind of aligns with the new mission of Airbnb going forward. So obviously they have a seasonality due to travel and vacations and so on. And what they are trying to achieve here is trying to transform Airbnb into some sort of remote work alternative home solution. So not just for your holidays, vacations, and so on. So they actually are trying to get people to do longer stays. So we can see that in Q4 overall in Q4 2021, 47% of the gross nights booked were actually for stays that were longer than 7 nights, or at least 7 nights. So that shows that a big chunk of the bookings are now longer term, which is what the company is kind of aiming for and going for. And because of that market, obviously they don't have that seasonality impact there. They can attract more people to actually live in an Airbnb for months at a time. And also the CEO has now started his experiment where he goes into a new home every 2 weeks for a year or so, and he wants to kind of showcase that it's possible to live in an Airbnb for longer term. So yeah, this is basically the longer term, I would say 2030 vision for the company, to have Airbnb moving from a primarily vacation platform to a work from home, remote living lifestyle app. So excited to see where that goes. In terms of ADR, so that's the average daily rate you charge your customers for the nights that they book. So we did see the average daily, the ADR at 154 for Q4. So it's basically representing a 20% increase for last year, for the Q4 2020. And a 36 increase from 2019. So we did have that consistent increase in average daily rates. Obviously, real estate prices, but also inflation and so forth, all have been going up. So to actually keep up with that, hosts had to increase their rates as well. But that's obviously what Airbnb wants to see, besides their gross booking value to be growing. So they want to see more hosts coming on, more gross booking volume, but also then obviously the average daily rate per booking to be up, so that overall we get that really good effect there in terms of a revenue growth perspective. Another summary here. So this is the visual of all the data for the last 3 years and all the quarters basically. So it's a good visualization, I think, in terms of to see how COVID impacted the business. So obviously we had, we started Q1 2019 with 81 million nights and experiences booked, which then decreased and increased rapidly in 2020, obviously due to COVID. So we had, as less as 28 million nights booked in Q2 of 2020, which then obviously when the vaccine came out and economy started to reopen again, we see it basically bottoming out here in that extreme lockdown period, and going up now consistently, then exceeding the 2019 highs of 85 million almost here in Q2. But then now the last 2 quarters, we've actually, I guess, with Omicron and new fears and new restrictions, we've seen a further decline again. Which usually Q3 is their strongest quarter, as you can see in most years, which was not the case for 2021, because I think that did have to do with the Omicron, the surge of the Omicron variant. But yeah, you can see that Q4, they're holding up pretty nicely here, still down on a, from 2019 perspective, but actually up from last year. And the same goes, if you go for gross booking value, we do see a different story due to the ADR down here. So the average daily rate, charged for each night. We did have the highs coming in here at 10 billion for Q1 2019, which then dropped substantially, obviously the same thing. But then we actually caught up with that Q1 19 level in Q1 2021, and since then we've been exceeding those levels of the past 2 years. So that's obviously, that's how they counter effect that, restrictions and lockdowns and so forth, that the average daily rate is actually consistently going up. You can see that here, it's being around 150 plus for the entire year. So, and I do think that the trend probably is gonna be consistent here, and the trend is gonna go up as well. Now looking at their financials actually here. So we did have, as we mentioned before, in terms of the revenue, we did have Q4 2021 coming in at $1.532 billion, which is up 78% year on year. From a 2 years perspective, it's still up because of the higher average daily rate. So it's up 38% from that perspective. So impressive to see that, that's why they show the 2 year growth, because that's actually, showing that, clean growth without the COVID impact. We're still running at a 38% revenue growth. That translates obviously now into net income and adjusted EBITDA. So net income just below in the profit and loss statement, after everything is deducted, we're still running at a 55 million, which is the highest net income recorded in any of the Q4 quarters in the history of the business. We did have a very, very strong quarter last time at $834 million, which was the highest ever recorded. So the same goes for the adjusted EBITDA, which came at $333 million. Adjusted EBITDA means earnings before interest, depreciation, amortization, and tax as well. So that's basically your revenue, deduct the cost of revenue, get the gross margin, and after the gross margin you just deduct all the operating expenses such as marketing, payroll, and so on to get to your EBITDA figure. They've adjusted that to actually exclude share-based expense, which would be bringing that number actually to a negative amount, I think. But nevertheless, it's a record quarter for the business, and they've been doing really well. And if we go down here to the free cash flow number, which I really love to look at, we can see that every quarter, every of the 4 quarters in 2021 were positive, and were, massively positive, not just a little bit, but, we had 480, 780, 510, and 376 million of free cash flow last quarter, compared to a very different story the last 2 years, where it was sometimes positive, sometimes negative. Now we do see strong management performance, strong performance of the business, actually running at a positive rate for all of those. And this is what you want to see as an investor, because the free cash flow is basically your operating cash flow, so all the cash you're collecting from your customers after reinvesting, after paying the bills, and after investing into capital expenditures. So that's the amount of cash left for the business to invest, to do research, and to develop new products or services, or to redistribute to the shareholders in form of dividends or share buybacks. Whatever the company or management chooses is the right thing to do. When we look at the P&L, the profit and loss statement, from an overall perspective, it's really good to see that they can keep their cost of revenue quite low, actually comparable to 2020, although revenues up almost double the amount of 2020. So that's impressive, and that's obviously really good gross margin. All the other expenses remain pretty similar, which is really good to see, because usually if you have higher sales, you usually have higher sales and marketing expenses, or something happened, and it usually just gets net off. But this business basically just means that not much marketing is needed, or not more marketing is needed to generate more revenue. People know already about Airbnb, and obviously anyone that wants to book a trip, they will end up browsing through Airbnb at least once to see what's there. Product development, we had a sharp decrease here in 2021. Look into that to see what's actually driving that. But other than that, we did have a similar level of operating expense. Yeah, obviously that one was 1 billion below 1.3 billion, leading to a better total cost and expenses. and then also obviously leading to a better income. So on a net income basis, they're running at a loss. So this is from a GAAP perspective, loss of 350 million, the accounting loss, but as we see in free cash flow and adjusted EBITDA was all positive. So we do go into the right direction here, and obviously up massively from last year, where we did have the IPO and other expenses skewing this a little bit, but overall very good to see. From a balance sheet perspective, not much to see here, I would say. Not really anything alarming, other than we do have current assets such as cash going up, which is good, building that buffer for the business. In terms of other assets, I mean, I don't really want to get into much into the detail. We did have a slight increase in long-term debt, but if you look at the number, it's 2 billion compared to 6 billion in cash, so they can pay that off 3 times. And no problems at all. So I don't really worry about the debt at all, or about raising interest rates or something like that. I don't really worry about that. We did have some additional share capital obviously here. So share dilution, that's one factor to consider always for high growth stocks. So you don't want to see it too high. I mean, this is quite a high number here. That's more than 10%, I would say. I don't want to see more than 20% increase in the dilution, because otherwise you obviously counter-affecting your growth rate that you're running at, and you as an investor are getting less for your money, although the business is growing. So ideally we would see some share buybacks if they have excess cash and they don't have anything else to spend it on, but let's see how next quarter looks like. Last thing to discuss here from a financial perspective is obviously the guidance for Q1 2022. So that's obviously something that investors don't just look at the past, but they also look at what's coming next. So they're calling for revenue between 1.4 and 1.48 billion. So that's an increase of 69% on the low end and 76% increase on the top end from the last quarter in 2021. So good numbers here, optimistic numbers as well, and that's obviously also an increase of the current quarter's number. So that's good to see. So now coming to the valuation. So obviously now we have a positive reaction of the market after mark this up. So the stock would actually be trading around 188 to 189 at the moment, the way it looks. So we want to look at some of the multiples to see where's the stock actually trading. Is it still cheap? Is it still a good deal at those levels? As you can see down here, so what I've called up is the price to sales ratio. So if we go into the full year, or basically the full history of the stock, we can see that it started around the 20 something level. Then we had a hype period where basically growth stocks went to a lot of hype in February 21, where it was trading at some levels at the peak at the level of 33 price to sales ratio, which is insanely high. Obviously, we did see that coming down then to as low as recently we had around a 12 price to sales ratio. So at the moment we're looking at 15, which 15 seems to be, I mean, we don't have much history of Airbnb, but it seems to be a number that investors are happy with for the last year or so, at least for the last 8-10 months. So it's not overly hyped or anything. Like we do look at a good number. 15 as such, I mean, if we compare this to the other competitors, there's not really such a competitor. That's why I like Airbnb as well, because it's a monopolistic type business. They're just doing something disrupted that not a lot of companies are doing, and the ones that are doing it, they just don't have that market share that Airbnb has. So we do see Airbnb trading at a higher multiple compared to other sort of hotel related stocks. But obviously you wouldn't assume that Airbnb has the same multiple than Booking or Hilton or Expedia even, because first of all, we have high gross margin, and second of all, Airbnb is more a tech type business. They don't own assets, they don't maintain anything. They are just basically building a tech platform, online platform for bookings, for experiences. Obviously also expected to be growing at a higher rate than these other ones. So we can say it's not cheap when you look at it from a price to sales, price to EBITDA ratio, but Obviously we're expecting them to grow at a higher pace and rate than these other competitors, so-called competitors here. So I do think that 14, 15 is kind of, reasonable. I mean, tonight, if you go up 5%, basically that means it will be around maybe 16 price to sales ratio, which, it gets there. I mean, it's kind of, if you believe in the long-term vision of the company and you expect them to grow revenue, I mean, not as we've seen recently, because obviously we had these crazy comparisons from the lows of the lockdowns. But if you compare that to, if you go back to the levels of 2 years, so we still grow at a rate of 36, 38. So that's massive revenue growth rate. And as they grow their revenue and they become more mature, we will see, or hoping to see, more net income down the line. So I do think that revenue growth here is still pretty strong. So it definitely deserves a higher price to sales ratio than something like a Hilton or whatever is mentioned here. And obviously, as we said, so basically the revenue is more worth per dollar, plus the revenue rate at which they're growing is also more. At the moment, we're around 106 to 110 tonight, probably 110 billion market cap, which, hotel and experiences and travel related market, and as such also the real estate market is obviously massive. So there's still huge amount to grow for Airbnb in the future. And I do think that it's not really trading richly at those levels. But obviously that's just my opinion. So you have to do your due diligence. This is not financial advice. But I hope you liked the video. Leave me a like and subscribe if you want to. And see you at the next one.